There's a reason why some of the wealthiest families in America pay a lower effective tax rate than their household staff, while successful business owners and high earners get crushed with over 40% taxes every single year. And for the wealthiest families, it's not because they're doing anything unethical or illegal. It's because they have a fundamental understanding of what effective tax planning really is. My name is Samuel Harnisch, and I'm the founder of Quantitative Financial Strategies. And after working with dozens of high net worth families, I've discovered that even some of the most sophisticated families make the same basic mistakes when it comes to effective tax planning. They think they're being smart with their money, but really they're leaving millions on the table because they believe myths about tax planning that just aren't true. Today, I'm gonna bust the 5 biggest tax planning myths that keep wealthy families overpaying the IRS and show you what ultra wealthy families do instead. Because if you're making multiple 7 figures or have significant wealth, the strategies you're probably using right now are designed for middle class families, not people in your situation. All right, myth number 1, just max out your 401k and you're good. For high earners, and I'm talking people making 7 figures or more, a 401k account is practically meaningless to you because there is a cap on how much you can contribute. Employees can only contribute $23,500 this year, which doesn't really do a whole lot for you in terms of reducing your income tax. What the wealthy will do is they'll use different kinds of defined benefit plans, like a cash balance plan, which allows you to contribute hundreds of thousands of dollars into a retirement account each year instead of just being capped at that smaller amount that the 401k is limited to. Now, how much you're able to contribute depends on a lot of factors, like your age, the number of employees, their age, how long they've been with the companies, and it's not a very simple process. You got to work with an actuary, a third-party administrator, and an advisor to actually implement something like a cash balance plan and do it correctly. But if you're operating a C Corp and you're able to deduct $300,000 at the company level and put it in a retirement account for yourself, the tax savings on that are unbelievable. Now, a lot of people that I talk to become obsessed with these cash balance plans or some other sort of deferred compensation plan that their employer might offer. And while it's great because you're sort of kicking the can down the road, you're deferring your taxes, at some point, if you're ever going to access the funds that are in those accounts, you're going to be realizing income, ordinary income, to do so. So while being able to defer larger and larger amounts from your income is step number 1, you can't forget step number 2, which is having some sort of a strategy in place where you're going to be able to convert those large multi-million-dollar retirement accounts into a Roth IRA where the money is never taxed again and you're not forced to take any distributions from it in your 70s. And what's really critical is that you have strategies available that you can use to offset the income when it's time. When you're doing the Roth conversions and you're realizing the income you've been deferring, you want to have an offset for that you can keep maintaining that deferral. Your brokerage account, if you're using the right strategies, just continues to embed more and more deferred tax liabilities that we want to be as big as we can possibly make them up until your death, when the account will receive a step up in basis, wiping out all of these deferred tax liabilities that we're just not going to pay. Myth number 2, municipal bonds are the best tax-free investment. I don't want to hate on my friends in muni land, so I do want to acknowledge municipal bonds are fantastic and they're wonderful. We're just stepping out from what makes sense for your average wealthy person, and we're going to start talking about some of the more advanced stuff that's out there. So the whole problem with it is something called opportunity cost, which is whatever the return I'm getting, I need to compare that to the next best alternative. And if I can get a 3%, 4% tax-free yield, as attractive as that may sound, that's not even half of what I could get if I'm pursuing other tax efficient investment accounts in my brokerage account. For example, if I look at something like real estate, if I'm managing it correctly, meaning in a tax efficient way where I'm maxing out my depreciation and I'm looking to 1031 my properties when that depreciation has run out, I can essentially create the same tax-free cash flow that you receive with a municipal bond, but it's also going to grow every year as I raise rents. So it's an increasing tax-free yield, and the properties themselves are also appreciating in value. So let's say cap rates today are sub 5. Well, you look at that and you compare it to a municipal bond, you say, oh, well, the yields are pretty similar. That's leaving out the future appreciation that we'll likely see in real estate properties. And so when you look at it holistically, your total return when you invest in real estate can actually be closer to a 10% return with a moderate amount of risk. Now, the biggest difference between municipal bonds and real estate is liquidity, but with the people that I'm working with and the situations we're talking about, we don't need substantial amounts of liquidity. If you have a $50 million net worth, you really can't afford to lock up $5 million in less liquid real estate investments that are giving you cash flow. Another strategy that can be very effective is a long short SMA, which is your own personal stock account with thousands of positions, both long and short. And what you can do is capture the stock market's return plus an additional return or alpha component from these long short extensions that are being managed. And in addition to that, realize tax benefits along the way of capital losses, which you can use to offset any sort of capital gains that you have within your portfolio or even exogenously with liquidity events going on outside of your portfolio. There are also tax-aware hedge funds out there that are managed just for taxable investors that can provide you with a super tax-efficient, diversifying return stream that's a great complement to your traditional stock and bond portfolio, much more diversifying than municipal bonds would be. And those ones can come with additional tax benefits in the form of ordinary losses, which you could take against your earned income and reduce your income taxes every year. And the last strategy that I would call out is actually a higher octane form of municipal bond investing for the ultra wealthy. And what you can do is they'll take the affordable housing loans that banks or asset managers will originate when they lend to developers to build these properties. What some managers are doing is they're taking the affordable housing loans, which are a municipal instrument, meaning the interest that it pays out is exempt from federal taxes, and depending on the state of issuance, it could be exempt from state taxes as well. And they'll securitize it, which just means they'll just break it into two tranches, an A tranche and a B tranche. It's a fancy way of just adding leverage to the strategy. And so what you can do is you're levering up what would have been like somewhere in the 4 to 6% range. You can lever it up into double digits while still maintaining the tax exempt status of the interest payments. And the reason why this is a specific area that is attractive to do this in is because the durability of the affordable housing sector. There's extremely low default rates, and there's often long waiting lists for new renters to step in if any of the current renters leave the property. So they have exceptionally low vacancy rates. And if you just look historically at how the sector has performed through like the global financial crisis, it's remarkable how resilient it is. And so you take something like that and then you lever it and you juice it up to a double-digit yield that's still tax exempt. And myth number 3, you should avoid capital gains at all costs. Where I most often see this one is for people that hold concentrated positions where their basis in it is extremely low and the gains are massive. And so people don't want to touch them. They don't want to sell, because the second you start selling, you're realizing huge capital gains that you're going to owe taxes on. And so some people, they've been very fortunate, just the public stocks that they've purchased, maybe it's Apple, Microsoft, Meta, Nvidia, Palantir, things like that, where people are up thousands of %. Or oftentimes you might actually be the founder of a company that has seen tremendous growth and gone public, and you're just sitting on all this equity that you kind of don't want to sell. Well, it turns out the number one way to lose your wealth is to hold it in concentrated positions. It can be a tremendous way to build wealth, but in order to maintain wealth, you really need to diversify your portfolio across as many different positions as you can. And there has never been more solutions available to people that are in this specific situation. And probably the most effective way at handling this is entering into something called a prepaid variable forward contract that is going to protect your position, and say you're only exposed to the first 10% drop, but then the protection that you've bought kicks in. And the way that you fund or purchase that is you sell away some of the upside. So let's say you're only going to participate in a 20% return and nothing above that. So you collar the position. And when you do that, a bank is willing to lend to you. And let's say when the 2 years is up on whatever contract you entered into, you're delivering the shares to the bank, which counts as a realization and triggers the gains in the position that you've been holding. But you've been able to harvest over $8.5 million in capital losses thanks to the long short equity SMA. And they net out, and what you're left with is a completely diversified equity account that continues to harvest capital losses every single year and has a chance to outperform the market, going long good stocks and shorting bad stocks. Myth number 4, charitable giving is just about the deduction. I cannot tell you how many people I've met that are still writing physical checks to the charities of their choosing, not realizing that that is the least tax efficient thing that they could possibly be doing. When I donate cash, I get a deduction equal to the cash that I donate. If I have a highly appreciated security, I spent $10 on Apple stock and it's worth $100, I can donate the Apple stock and get the full $100 deduction, even though technically speaking, $90 of that 100 was a gain I was going to owe taxes on if I sold the position, but that's ignored when I gift to charity. I got a full deduction for the $100. So you're stacking your normal charitable deduction with the avoidance of long-term capital gains tax that you would have owed. Now, what I really like to do for people is instead of just donating the same amount of money to charity each year, you can do a bunching strategy where you set up your own donor advised fund. And let's say I usually like to contribute $100,000 a year to charities. Well, instead I could do $500,000 in 1 year to my donor advised fund. I get a deduction for $500,000 in that year. And then for the next 5 years, I'm going to make my normal $100,000 donations. Now I don't get the deductions in those years because I pulled them all forward into this year. But the reason why you would do that, I mean, there's a lot of reasons, but the main one is I have full control from a tax planning perspective of when I want or need to get a big deduction. So for a lot of people, it's in a big liquidity event year, or you had a huge bonus or some reason where you have outsized income in this particular year and you're in the highest tax brackets. So having deductions in those years are disproportionately beneficial than maybe in future years. Well, we want to bunch up and make more donations in that year, even though you don't actually have to send it to the end charity of your choice, you send it to your fund. Now, the other thing I want to point out is just how much more convenient these donor advised funds are. It's your own little investment portfolio that your advisor can manage for you and grow it so you're able to make an even bigger impact. You'll never have to cut a physical check again to make a charitable donation. You can do this all digitally, and the provider will create a check and send that out on your behalf with a letter of your choosing what you want to include on it. You can choose to donate anonymously. You can choose to put your name on it. And what it does is, instead of having to keep track of all the different donations that you make, there's just one entity and one report that you get that you would file with the IRS to get your deduction for any contributions you made to your donor advised fund. And it's also really nice just for tracking to see how big of an impact you've made on the different charities of your choosing over the years, because it's all logged and it's all digital, and they can make really neat reports that are honestly just fun to look through. Now, before I reveal the fifth myth, I want to be completely transparent about something. These advanced tax strategies aren't something you can implement just from watching a YouTube video. They require sophisticated planning, the right investment vehicles, and coordination across your entire financial picture. At QFS, we specialize in tax-aware wealth management for families with $5 million or more in investable assets. We bring institutional level tax strategies that most advisors can't access or frankly just don't understand. The reality is we only take on clients when we can make a meaningful impact, which means you need the right level of complexity and assets for these strategies to make sense. If that sounds like your situation and you want to see what's missing in your current approach, go ahead and use the link in the description. All right, anyways, back to the content. Myth number 5, tax planning is something you do just once a year. Tax planning in December is way too late and way too limited in what you're going to be able to do. You really have to be working year round on your tax planning. And honestly, when I'm working with people, I'm not even focused just on this year. I'm already thinking what we're doing next year and the second year and the third year, and what are we doing when you retire, and what are we doing when you're in your 70s and your RMDs hit, and what are we doing with your kids, and what kinds of accounts are we going to pass to them, and which kind of accounts do we want to set aside or go into charity. And tax planning, it is just never done correctly if it's just looking at 1 year. You have to look out. You have to look out through multiple year periods and frankly even decades in someone's entire life if you want to optimize. And what that means in tax planning world is minimize someone's lifetime tax bill in order to maximize their wealth. So in order to do this effectively, it is critical that your financial advisor and your CPA, they kind of got to be like best friends. Like, the people who I work with, I get to know their CPAs very well, because at the end of the day, they have to be on board. They have to understand the different kinds of forms and filings that they're going to receive from your investment accounts. And we really want to integrate that into whatever sort of tax planning ideas that they have for you. And it really is a team effort where we're coming at it from different angles and we're both working together to serve you to reduce your tax bill. I think one of the most important areas for this is when you have liquidity events. Sometimes people think the plan planning doesn't start until you've closed the deal and you've received all of this cash, actually as far in advance as we possibly can. So I'm going to use my own family as an example. There's a multi-generational business in my family that will likely be sold within the next 10 years. We're not waiting to start tax planning until that day 10 years from now when the business is sold. And we're accumulating these capital losses, which we're just going to use to offset whatever gains are realized when we sell the family business. Now, that being said, we can still do amazing work even in the single year of a liquidity event. It just makes it a little harder, but it's possible with these long short strategies that you can actually harvest over 90% of whatever you fund the account with in capital losses in year one. Now, if you can break it up into an installment sale, or you can make some sort of a small charitable donation, you can essentially have deductions to offset the entirety of the liquidity event. So what you really want to do, if you want to model what the ultra wealthy families are doing, they make these family offices where in-house they have a chief investment officer. That would probably be equivalent to like whatever financial advisor you're working with. They'll also have CPAs in-house, and they'll have legal and estate attorneys, and all of those people are working together, bringing their unique expertise to solve for whatever the family's tax pain points are. And you really can't have one without the other. I mean, if someone came to me and they said, hey, I have $5 million, what should I invest in? I would say, I don't know. What tax bracket are you in? Where is the money located? Is it in a Roth? Is it in a taxable account? Is it in an IRA? All of those factors matter. And so you have to get customized, tailored advice to your specific situation, because it is not the same for everyone. There's some people where the vast majority of their net worth is all just in a taxable brokerage account because they sold a business and they didn't have some sort of big cash balance plan or something going. They don't have many retirement assets, but they have this huge nest egg in a taxable account. Well, the way we're going to manage that is completely different than the way that we would manage assets that are in a tax-free or tax-deferred account. And so if you're the average person that has a mix of the different account types, you're going to want to have different kinds of investments placed in different accounts, and it's all integrating with your financial plan and picture that's unique to you and your family. So here's the real cost to you if you're only using basic tax planning strategies. If you're a high multi-seven-figure earner, well, you might be losing close to half of that a year, and once that money is gone and you've paid taxes on it, you never get to see it again. You never get the chance to invest it and compound it and grow it. It's just gone. So imagine if you had just a $500,000 deduction that you could take every single year. Well, that would be around $250,000 every single year that would have gone to taxes, that goes right into your pocket. And ideally, you put it back into the portfolio to grow it and make even more tax deductions. And you sort of start this snowball effect that just keeps compounding and growing. And so that's income over here. If we're looking at some large gain, selling a business, selling a concentrated stock, maybe you have stock-based compensation in something that's just had a huge run up. Again, you could be losing, even if you get long-term capital gains treatment, that's 23.8% when we're talking at the levels we're talking about, 23.8% at the federal level. And then if you're in a state like California, they're going to tack on another 13.3%. And so you're going to lose over 30% of whatever the value it is that you saw and you created. 1/3 of it, again, just gone, lost to taxes. It's not available. It's not in your portfolio. You can't grow. You can't make more tax savings off of those dollars. And so you're really just taking like a huge step back to then try to compound and start over and get back to where you were before you had this huge tax bill. So to bring it all together, why don't I give you an example of someone I'm working with? Their net worth is around 20 million, and that includes real estate properties, a brokerage account, retirement accounts. There's a really great diverse sort of asset mix that this person has accumulated over their life. Now, when we started working together, they had a real concentration issue where they had 3 stocks that were worth millions of dollars, just the 3 of them, and the gains on them were massive. That's part of the reason why people end up with concentrated positions is they go, oh, I don't want to pay the taxes. And if it just keeps growing as a percent of their net worth, if you were to look at a pie, it just keeps getting bigger and bigger and bigger. And a lot of people that own Nvidia are in this exact situation. So what we did is we initiated a long short equity account, which enabled us to diversify down those positions to their appropriate weights without actually having to pay any capital gains taxes because of all of the capital losses that we were able to harvest. We then plugged in some real estate investments so that they're getting tax-free cash flow every single month. And we took their big retirement accounts they have, which are great. They're the last place we would go to if we ever needed liquidity. So it's a great spot to make private equity investments. And then we've got tax-aware hedge funds going in their brokerage account assets. And those are giving us ordinary losses, which we're now able to use. We're doing Roth conversions where we're moving the private equity investments from their traditional retirement accounts over into a new account, a Roth that we opened. They had never been eligible before to contribute to a Roth. Roth, they never thought they would have a Roth IRA. Well, now they do, and we're moving money into it tax-free, hundreds of thousands of dollars a year, and we're getting to compound private equity in a Roth IRA. What that person's holistic net worth will look like 30 years from now after all of the strategies we've put in place, compared to if they had kept a concentrated position and they were investing in taxable private credit and bonds in their brokerage account without having offsets or deductions for it, it's going to be orders of magnitude larger because of the way that we're doing it. And so everyone needs to sort of have a mindset shift of tax time is not just about filing your taxes, looking at the tax bill and being like, darn it, this was a brutal year. I'm getting taxed $1 million. It should never come as a shock to you what your tax bill is. We should be planning for that the entire year and knowing within reason, within a really tight range, what we estimate your taxes to be. Most wealthy families think they're being sophisticated with their taxes because they have a good CPA and they're maxing out their retirement accounts. But the reality is they're using strategies designed for middle-class earners, not those with significant wealth or complex financial situations. The ultra wealthy understand that tax planning isn't about finding loopholes or doing anything too aggressive. It's about integrating tax-aware strategies into every aspect of your financial life, from how you invest to how you structure your business to how you plan for passing wealth to the next generation. If you're ready to stop overpaying taxes and build wealth the way that sophisticated families do, click the link in the description to book a consultation call. We'll review your current tax situation and show you exactly where you might be leaving money on the table and how we might be able to help you keep more of what you earn. Make sure to subscribe for more videos that challenge the conventional financial wisdom, and I'll see you in the next one.